Hey everyone, it is Evan here from the Trade Risk on Tuesday, September 10th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So it's good to be back. I missed last Friday on the weekend recap. The usual Friday video did not go out. I was on the road traveling, but I'm back in action now, and let's jump into what's going on here in the markets. Major indices were mixed today. You can see it was green for the Dow and the IWM, and it was red for the S&P 500 and the Qs. Take a look at the outperformance today, though, in the Russell 2000 in that IWM, up 1.27%, while the rest of the market was, basically flat. 5-day change numbers all very strong, and once again, take a look at the Russell 2000 here, pulling away from the pack and starting to outperform 5% almost to the upside over the past 5 days of trading. And when we look at the major indices versus their key simple moving averages, we are above the 10, 50, and 200 SMA across the board. If we scroll down here and take a look at sectors, semiconductors at the top of the list, followed by Dow Transports and energy. On the downside, defensive tone, it is utilities, it is staples, and it is healthcare. On terms of major markets, we have natural gas up over 10% over the past 5 trading sessions, followed by oil, followed by China. On the downside, we have volatility, which is down 21% over the past 5 days, followed by silver and TLT. So definitely saw or see in those numbers there the rotation into risk assets and the pull away rotation out of the defensive areas, safety havens of the market. And all of that, if we look here on a weekly chart, makes a lot of sense because last week we did get our breakout above the August range. We spent 4 weeks going sideways, chopping around for about 22 sessions, I think it was, dancing around in here in an elevated state of volatility. We finally broke out and cleared over that 2942 range, call it. We closed strong last week and resolved that range to the upside. And now you can see we are flat to sideways, slightly down here so far to start this week. What we basically are looking for now, or certainly what the bulls are most interested in now, is defending this breakout that just occurred last week. So we just resolved this range higher. This 2950 area is really the prior highs back here from May, and then a little bit above the 2018 highs there. Really, that breakout comes more, closer to around that 2940 area. If we jump down to a daily chart, you can see we gapped right above it. So 2942 or so, that's essentially the breakout level. You can see the open gap. We attempted to get in there today, but bulls did defend that open gap, and it's yet to be seen. Maybe this turns into a breakaway gap that the market can start to, really not fill and run away from. As it stands right now, the market, at least as of today on Tuesday, tried to pull back. It rebounded and closed just slightly down off of the lows, and we're going to need to see over the next couple of days if the bulls can continue to hold up and defend the breakout here that occurred last Thursday. That's the big developments there. That's what we're looking at right now. I think it is the bulls breakout to lose. It is the bulls market to lose. They have the trend momentum at their backs right now, and we're going to need to see if they can defend it and add to those gains and eventually get us up to retest these prior highs. So that's sort of where we're at right now. We're only 1.9% away, just under 2% away from the all-time highs made back in July. So we're quite close to them in the S&P 500. MACD here at positive new high territory there, and we are holding above this level. So on the downside, 2950, 2940, that's what we're going to be looking at. On the upside, we have yesterday's highs, which is 29.89. That's exactly where the market opened and then basically proceeded to sell off yesterday to start off the week. If we can start to take that out, then we set our eyes on retesting these all-time highs up here just north of 3,000. Now, one thing that when we look here at the VIX, the VIX is still kind of keeping it together. It hasn't quite unwound and given everything back. Notice we're well off of the lows that we saw back here in July and even in June when we were trending back up to those new highs here. We had a VIX in the 12s for most of that time, a little bit into the 13s. You can see we're still holding around 15, 15 and a half. So there's still some fear in here. There's still a little bit of edge out there, so to speak, with the VIX holding up at 15. Again, this is generally historically average levels, so this isn't certainly isn't pricing in some type of meltdown or any type of extreme fear by any stretch, but it is at least notably still putting in kind of a higher low, if you will, or just a more elevated floor from where we were back in July. So that'll be interesting to see if there's more unwind to come, if this market can continue higher and start to eventually get up there and retest those highs. Now, the IWM, I think, is the most interesting story, because here, if we look at the IWM on this week, we have most of the major indices, which are flat to slightly down, and here we have the IWM, which is up 2.6%. Now, this has been underperforming for quite a long time, so a little bit of outperformance here is nice to see, and it's something that certainly should get our attention, because it's been a while since we've seen this. We've seen 3 days over the past 4 sessions where we've actually seen heavy volume come in to the upside, which is classic sort of signaling of potential, accumulation there, going up on higher volume. Always a good thing to see. And we are breaking above, again, that August range and this slight downtrend line channel that we had in place. So if we go back to kind of this view here, looks like we have some clearance back here all the way up to potentially get back up to the June, July highs here, up around 158, the upper 150s, when we repeatedly failed for many months, almost a year's time, underneath that 160 level. We do seem to be, looking like we want to just kind of launch right back up into this range, perhaps test the upper end of it, perhaps break out of it. Of course, this is all getting ahead of ourselves. We need to take it one day at a time. It's likely not going to be a straight line, but it is encouraging to see the outperformance, the increase in volume, and the break of resistance here for the Russell 2000, something to certainly pay attention to. Last but not least, if we look at the NASDAQ 100, this looks very similar to the S&P 500, maybe a little bit weaker actually, particularly today, because this did get in here and fill most of the upside gap that we saw last Thursday. So when this broke out, we can see we kind of came back down here. Didn't totally fill it, but we certainly filled a good chunk of it, and then we did reverse and close near the highs, well off of the lows today. So again, a good stage by the bulls there to step in, buy the dip, defend the gap, and the breakout from last week. So a little bit weaker here for the Qs, much stronger for the Russell 2000, stronger for the Dow Jones as well. We don't usually look at the Dow, just sort of time and redundancy of looking at all the major indices, but the Dow Jones is actually got some good momentum there. Notice where it is. In fact, it closed at new highs today. So in fact, and when I say new highs in the short-term basis, we extended the breakout here and closed at new highs here ever since breaking out last Thursday. This is also a nice leadership area. So it's the Dow and the Russell which seem to be getting some love, getting some rotation here on this latest leg higher. That's a bit different than what we're used to be seeing. So that is it. That is the major markets. Those are the developments there. We've seen momentum to the upside. We've got the breakouts. Breadth has been pretty good and strong to the upside as well. It is the bulls' case to lose at this point. Now, if we go into some of the other major markets, we'll kick it off with TLT. You can see this had been the defensive area of the market. This had been holding up and acting quite well during the volatility of August, but you can see now with the equity markets rallying, a little bit of unwind here happening in the TLT, and deservingly so, because by most pretty much any historical metric you want to use for markets being stretched, the TLT fit in that category of being extremely stretched to the upside. So some unwind here. It's happened pretty quick. We actually just closed out a short trade here on the TLT. So we in fact initiated a short position back here on the 3rd. We covered half yesterday. We covered the rest towards the end of the day here today, and we locked in that short trade on the TLT. We were playing it via TMV, which is just a 3x leveraged inverse to the TLT. So this, especially a leveraged ETF, works well in something that's slower moving like bonds. So, capturing a 11-12% move here in 5 days time is where the benefit of leveraged ETFs can come into. But that's sort of a topic for another story. We had a position, we covered it. Do still think this could fall lower here. It certainly has room to for the quick tactical trade and opportunity we were looking for. We hit our targets today and we are out of it, but it does still look like it needs time here. I wouldn't want to necessarily be a hero trying to buy the dip here on the long side. I'd want to let this settle in. I don't think they'll just let this, totally be left for dead here. A strong move like TLT. Maybe this was the blow off, but I'd still want to be cautious here of getting too aggressive on the short side. I think if you were to look even at a trend line like this on a weekly chart, and I know this isn't drawn precisely, but I wouldn't be surprised to even see a move down into the mid 130s to really kind of reset, come back down to trend and wash out a lot of the froth that was in here recently. That seems reasonable in the next couple of weeks, but again, we'll take it one day at a time and see how that how that develops there. But for now, trend is to the downside here in the short term, and bears sort of getting a little bit of revenge there after a long sort of hibernation. If we look at gold here, also had been acting as a safety haven, has been pulling back as well off of these highs. It was quite stretched as well by most traditional metrics, maybe not as stretched as TLT, but still pretty stretched. You can look at some of the longer term trend lines like this that started the move from May. We're kind of coming into the first level here where we might start to get some interest or some buyers kind of looking at this trend line over here if that slope is going to hold up. Once again, very similar to TLT, just don't want to be too much of a hero, kind of trying to dip by and jump in while things are moving down. This is taking a little bit more of an even-keeled approach, with that trend line that's coming up and then some of these lows in here. Again, it looks like potentially a spot pretty soon here where you might get some reaction to the upside. Silver also in the kind of that same camp here, and silver really ignited aggressively over the past 2 weeks or so. This latest leg in August here into the end of August is really where silver got a little silly and started to extend itself pretty strong. It's pulling back on some heavy volume here. It's had a nice run to the upside. Again, you can kind of extend those trend lines and see where that slope kind of comes in and potentially look at that as starting to nibble on the long side for now, letting this kind of simmer down here. But I do like silver right now. I think out of all of these, silver, gold, and TLT, I'm most interested in potentially re-entering silver sooner than the others, but for now, no plans or no immediate setup here to get back involved. So that covers almost everything. We got energy here. So let's take a look at oil. Oil kind of failing and fumbling a little bit today around this $12 area. This has been a prior sort of inflection point for USO. There's a good amount of supply that's traded in here over the past, 6 or 7 months throughout the course of this year. So a little bit of hesitation here makes sense. But for me, still would like to see this settle in, just cleaner markets out there, in my opinion, to trade right now. But oil, if it can get going above today's highs, above $12, it looks pretty good. Natural gas also looking pretty strong here recently. This is really ignited to the upside here, seeing consecutive days of just sharp moves higher. This had been looking pretty much as bad as you could sum up on basically every time frame just about a month ago or 3 weeks ago, and that generally when something looks as bad and uglier than it could ever look, that probably is a point where you're going to get some type of reaction higher. You're seeing that today and again, or the past couple of weeks here, and it is now in very short order about 26% off of the lows made in early August. So natural gas extended, breaking through resistance. It's a tough chase right now, but certainly the squeeze is on, momentum to the upside, and bulls are enjoying a rally they haven't seen in quite some time. So that is it. That is what I have for the midweek market update. Thanks so much, as always, for tuning in and watching. You can subscribe on our YouTube channel, follow us on the Trade Risk. Have a great rest of the day, and we'll see you tomorrow back here for our trade ideas video during the trading session.